Hi everyone, this is Professor Sam Lanzafame once again, and we are going to continue where we left off in our last presentation. In our last presentation, we actually completed a multiple step income statement. I'll show it to you real quick. And we took information from an adjusted trial balance, and from that data, we created a multiple step income statement, a very simplistic version of a multiple step income statement. The result of doing the income statement, we arrived at net income 8,900. So what we're going to do now is take that same data and let's do closing entries. I've done a previous presentation on closing entries, but this is the first one involving merchandising information. So for a merchandise company, we have some new accounts, if you recall, things like sales, sales returns, sales discounts, cost of goods sold. These accounts did not exist when we were dealing with a service company, so the closing entries look a little different, but pretty much the same content. And the process is basically the same. So if you can shift your eyes over to the right side of the screen, you'll notice that I have the purpose of closing entries up in yellow. Number one, the purpose is to update capital. If you are in a corporation setting, the purpose would be to update retained earnings. Number two, we're also trying to get the net income figure, this 8,900 that we calculated in the previous presentation. We want to get that 8,900 to somehow appear in this journal, and as well as the general ledger, which is not being identified here today. And then number three, we want to close the temporary accounts. You may remember from an earlier presentation, I referred to these temporary accounts as the red accounts. So we want to close out the revenue account, we want to close out the expense account, and we want to close out the drawing account. If you are in a corporation, instead of drawing, we would have dividends. Okay, so when it comes to closing, there are basically 4 steps. The first 3, mandatory. The fourth one, it depends on whether or not the company had a withdrawal or a dividend that period. So you have a minimum of 3 closing entries, a maximum of 4. So the first one is to close your sales into income summary. We used to close revenue into income summary, service revenue to be more specific. We're still closing revenue, it's just that the account now is called sales. Then the second closing entry, we close all our expenses, anything that ends with the word expense, along with cost of goods sold. Remember, that's an expense account. Freight out, as you can see at the bottom left in pink, that is also an expense account. So all of the expenses, along with the 2 contra sales, the sales returns and the sales discounts. Notice over in the trial balance, they are on the debit side. So expenses along with the contra sales, they act as a reduction of sales. So they get treated in the same journal entry. So we close them all into income summary. Closing entry number 3, once we have a balance in income summary, we close that into capital. And by the way, if this was a corporation, instead of capital, we would be using retained earnings. Finally, the last closing entry, you may or may not need to do it, depending on if the account was used during the period. But if it was, you're going to close drawing. And if you're dealing with a corporation, you would be closing dividends. And you're going to be closing your drawing into your capital account. If this is a corporation, you'd be closing dividends into retained earnings. So just a little FYI there for those of you that may have a little corporation accounting under your belt. So a reminder in green, the net income from the problem over to the left was 8,900. We're hoping to see that 8,900 one more time. Where specifically? Closing entry number 3. Closing entry number 3 is where you close your income summary into capital or retained earnings if you're in a corporation setting, and that journal entry must always have the net income figure in it. So if your numbers come out and you end up with the same number as you got in net income and closing entry number 3, it's kind of like a check figure, kind of like a self-check when you're doing the closing entries. Okay, so let's go ahead and get started. The first closing entry, we're going to follow the little blue steps here to the right. We're going to close sales into income summary. Remember, when doing closing entries, think opposite. We want to shut things down. So we're going to do the opposite of what we normally do. So look at sales revenue. It has a credit balance of $800,000. In order to close it, we got to debit it. So we are going to debit sales revenue, and we're going to debit it for $800,000. Then we're going to close it into this made-up account that serves one main purpose, and that's to help you close your revenues and expenses. So we're going to close it into income summary. And there's your first closing entry. First one is done. Now, it might be in your best interest to create a little T account to help you kind of figure out what's going on with income summary. In real life accounting, you're actually posting these transactions to a ledger. But since I don't have a ledger here, maybe we can do like a little scrap paper version of a ledger, which is what is called a T account. Okay, so we'll just kind of track the activity of income summary. This will help us tremendously when we get to closing entry number 3. So keep that in mind as we go further along. Okay, the second closing entry is to close all the expenses along with the contra sales accounts in income summary. So if you look at all of the expenses, cost of goods sold, sales return, sales discounts, you see all those, they have a debit balance. To close them, we got to credit them. But when you do a journal entry, you always have to write the debits first. So I know we're going to be closing these into income summary. And the amount that's supposed to go in there is kind of a mystery guess right now. So we'll just kind of leave that kind of blank, give it a certain color here, and then we'll come back and fill that number in. Okay, we'll just make it green. So I need to eventually put a number in this spot that's going to add up to all of my credits. So let's credit all of the sales returns, sales discounts, COGS, and the remaining expenses. So we're going to credit sales returns and allowances. And that number is 12,000. We will do the same thing with sales discounts. It does not make a difference which one you do first or second or third, as long as income summary is first, and then all the credits that you have, it's irrelevant what sequence they come in. Remember, debits always go first, followed by credits. In this case, we have like 7 credits. It doesn't matter what order you put these 7 in. I'm just going to follow the sequence that's in the trial balance. This way, I don't mess up. We got salaries and wages expense. And that one, let's see, is 240. We have advertising expense. And that is 12,000. We got freight out, freight so. Sorry, bad joke, but you're used to that with me. 15,000. And finally, rent expense for 30,000. So now we're going to add all of these up, and we're going to put the total in that green debit spot. So give me a second to create a formula that's going to add these for me, and I end up with 791,100. So let's put that over here. And now let's see what our balance is in income summary. Drum roll, please. You are hoping like crazy that the balance in income summary equals net income. So let's see if it does. This is what's going to tell us if we did it right, and we have. Notice the 8,900. By doing this T account, not only do you get like a relaxing feeling that you got the right number, it also prompts you on how to do the next step. Remember, closing entry number 3, step 3 says close income summary. Well, remember, when you close something, you got to do the opposite of the current balance. So if the current balance right now is 8,900 credit, to close it, we got to debit it. So that's how you figure out how to do that third entry. So we are going to debit income summary for 8,900, and we're going to close it into the capital account. Lanza Capital, and that's for 8,900. And then finally, your last closing entry, depending on if you have the account in the mix, and we do have a drawing account. So if drawing was not there, we'd be done. We would have been done after 3 steps. So because there is a drawing account, we got to close it. So notice drawing has a debit balance, so to close it, we have to credit it. So let me skip the debit spot, and let's credit the drawing account for the 10,000 that you see there. And then we are going to debit for 10,000 as well. Remember, debits have to always equal credits. And we have Lanza Capital as the debit and Lanza Drawing as the credit. That's it. That's how you do the closing entries. So just a quick little side note, this company earned $8,900 worth of net income, but used $10,000 for personal use. So their equity balance from the beginning of the period to the end of the period has actually decreased. Notice the drawing is larger than how much the capital went up. So capital went up by 8,900, it went down by 10,000. So if we were to do another trial balance, like the one that you see on the left, that Lanza Capital that you see for 95, after this closing entry process, it would be lower. It would be less. So the net worth of the company has actually decreased based on these numbers. So yeah, it was great to have a net income, but they took too much money out for personal reasons. So kind of offset all that positive. But who knows? Maybe they needed it. All right, that's it. Thank you very much for joining me, and we'll have another presentation coming up soon on a completely different topic, more probably things along the lines of FIFO and LIFO and weighted average and how to calculate ending inventory without just automatically just being given that number. So stay tuned for the next presentation. Take it easy. Bye-bye.